let's kind of get into some of the things that we're going to talk about today. We're going to show some bear market history and talk about bear markets and how it is just part of the process of being an investor, and maybe some of the best practices that one should follow while in this bear market. But guys, this market will turn at some point and there will be a bottom at some point. And for those of us that's in the market, we'll recover and make a lot of money. Now, am I hurting right now, Patrick? I'm hurting, dog. Oh my God, my account is down hundreds of thousands of dollars. But again, you do not lose until you sell. And so in a bear market, cash is king. I had to do some selling, but for the most part, my core holdings, some of the things that we will talk about today, got to hold on to them. You have to be a long-term investor. So Patrick, let's get into what you want to share today. Let's start out with this whole thing that you have on bear markets here. So let's go there.
Okay, so this is an article in Motley Fool, and that's a good source for investment research. So, anyways, stocks just hit bear market territory, but here's why you don't need to worry. And this is an article that was published on May 22nd, so just this morning. So, what are the key points here? After weeks of turbulence, the S&P 500 plunged into a bear market, as I was discussing earlier today. While it is natural to be nervous when the stock market values fall that substantially, here's why you should not panic. Okay, so on May 20th, which was just last Friday, the S&P 500 index fell into bear market territory, and now a bear market is defined as a period when the stock values fall 20% or more from a recent high, as I was just discussing, like from November to right now in May. Of course, this is the first time in over 2 years that the stocks have fallen so sharply. Naturally, people are very concerned because they have never, a lot of new investors have not experienced a bear market. Last decline of this nature happened in March 2020 on the heels of the COVID-19 outbreak. And this is where the nation was shutting down, or pretty much the world economy was shutting down, and a lot of businesses had to get those PPP loans. Of course, a bear market can be an unsettling thing, even if you are a seasoned investor. But here's why you do not need to start panicking.
Do not panic. Hold on
And
to your
as
heels.
and as my boy Jim Cramer would say, nobody has made a dime panicking.
All right, so let's go into some of these things to consider while being in a bear market. I honestly believe we're in a bear market. I believe that we're going to continue to go down for the next year, but it's a good thing because you're going to be able to get stocks, good stocks on sale, and you're going to make a lot of money when we ramp back up. And we'll talk about some of those stocks. But okay, Patrick, let's get into some of the things to consider in a bear market.
Okay, so as I was describing earlier um, in this broadcast, bear markets are not that unusual. And since World War II, there have been 17 bear markets or near bear markets. And right now, I think obviously we're in a near bear market, according to Morningstar report. That's not a particularly large number, but it's not a small number either. So if you are new to investing, you can rest assured that this sort of thing has happened before.
All right.
And bear markets don't always last that long. On the average, bear markets have lasted about a year. We're currently about roughly 6 months into this bear market, so maybe we're in the fifth or sixth inning of this bear market. But but that doesn't always happen. Bear market investors have endured the in the early 2020 was a fairly short-lived, and stocks managed to more than recover their values before the end of the year. That was 2020. That is. Granted, without a crystal ball, it is impossible to predict how long a given bear market will last. And we don't know how long this particular one will last, especially when you have inflation, the war in Ukraine, and of course the COVID lockdowns in China, which are causing supply chain issues. But while the idea of stocks going down for a year might seem terrifying, the reality is that you really only stand to get hurt by a bear market when you liquidate stocks at a loss. So if you leave your portfolio alone, you may not lose a dime during a bear market.
And that's a very key point, Patrick, because often younger new investors, who is our target market for young
Hmm.
families with up and coming investors that may be coming out of college or going into the labor force to build wealth, they may panic and see their account down by 50%, even 100%, but you do not lose money unless you sell. So your account may be down digitally, but overall, you haven't lost a penny. You make money when you sell. And conversely, you make money. You don't have money actually until you sell. So sometimes you'll see your account balloon and you do not take profits. And if you don't take profits, that's digital too. So you have to take profits when the market does roar, is the point. So go ahead, Patrick.
Yeah, so as I was saying, nobody makes a dime panicking, and you shouldn't panic in this particular bear market either.
All
Number
right,
one,
let's go ahead. Sorry.
yeah. So number one, the supply chain issues are going to be resolved. Number two, the inflation that's already in the system, I think, could be possibly peaking. A lot of the reports have suggested that, and of course, we got our Federal Reserve Chief Jerome Powell making sure that that doesn't happen. And number three, ultimately, the war in Ukraine is going to end, and Russia's forces will probably culminate. But
Oh,
anyways,
yeah, that dog is going insane in the background there, Patrick. But
and I apologize to our
oh
audience.
my freaking goodness, that dog. All right, let's continue, my friend. We'll work with it. I think the information overshadows the bark, and I think we all have been there. So let's continue, my friend.
Okay, so three, the stock market has a long history of recovering from bear markets. It is definitely unsettling to see your portfolio value tank, but it's important to remember that the stock market has a long history of recovering from downturns. Not only that, but some of the market's strongest periods of performance have happened on the heels of a bear market.
Yeah. All right, let's get to fall.
All right, so number four, during a bear market, stock markets stock values decline sharply. That's a bad thing if you're looking to liquidate stocks. But if you're looking to buy stocks, it's actually a good thing. Just imagine that you're at your favorite department store, and the you know you see your favorite T-shirt or favorite stuff to buy is on sale at 20% down, and you have money to buy these things. It's like, oh man, I'm in this is like a Black Friday.
Gotcha.
So right
That's.
now the market is going through an extreme Black Friday.
I think most of us have heard that story, buying the dip and all of that. So
Yes.
let's go past that. Let's get down here, Patrick.
Okay. Another good option during a downturn, invest in the broad market by buying shares of an S&P ETF. And here you're buying the 500 best market capitalized, the 500 of the best capitalized securities in the market. And some of the best ETFs you could buy would be the SPY or the VOO.
Yeah, those are good ones. And Patrick, this sentence right here is a good one because this is kind of where we're going. Focus on
Okay,
the same quality businesses. Go with that one, Patrick.
so instead of panicking, what you should do is focus on the same quality businesses you were buying before the market conditions took a turn for the worse. So, as we always talk about on our show, you always want to buy companies with good with a reasonable PE, strong earnings growth, and not pay too much for that growth.
Exactly. Now, lastly, Patrick, right here, try to keep your cool.
Keep your cool, keep your cool, keep your cool. A bear market can be scary, but the key is not to act impulsively when stock market values are down. Instead, find ways to stay calm, whether it's diving into a hobby or devoting more time to exercise and self care. At the same time, consider adding to your portfolio when stocks are down to set up yourself for some solid returns down the line. And this is why when you invest in stocks, it's important to listen to these conference calls when these earnings come up because they will give you the guidance of business conditions going forward. And these are good forecasts. And even though when the market comes down, the stock and the market's broken, the stock prices might be broken. However, the fundamentals of the company are far from broken if you're investing in good companies.
Exactly. Now, Patrick, I want to spin a bit because do you know Lee Cooperman? I want to play something. This is a long clip, but this is about a 4 minute clip, so we may lose some. We may lose some viewers here on this 4 minute clip, but this is a 4 minute clip from Lee Cooperman. Patrick, do you know who Lee Cooperman is? Because I want to share with our audience what Lee Cooperman is saying about this market. And he is actually predicting an indicator for the bottom of this market without looking at all of these crazy indicators and all of that stuff. Because a lot of our newer investors, they don't understand the stochastics and RSIs and the
Bollinger Bands and stuff like
Bollinger
that.
Band support and resistance. He had a simple method and he also provided some advice. So who is Lee Cooperman before I play this video?
Okay, Louis Cooperman is a guru. He's an investment guru or something. I think he was a long-time money manager or a hedge fund manager, and he's got incredible experience and significant insight. So he's a good man to listen to.
All right, so let me play this video by Lee Cooperman. Listen to what Lee Cooperman says that's been in the market for more than 50 years, says, how do you predict a bottom? And I'm going to look for this specifically and then listen to what he has to say about the top of the S&P for this year. It's kind of scary. And then lastly, listen to what his picks are. All right, let's go.
Let me say you've asked previous guests repeatedly to spot the bottom, or we're at bottom. Let me give you the best evidence of a bottom when it appears, and it does not appear currently. The best evidence of a bottom is a company comes out with disappointing earnings, the stock opens up down and closes the day unchanged up. We're not seeing that at all. So I would say the stock market not yet discounted the economic slowdown that we're experiencing, in my opinion. One, unfortunately, I owned Bosch & Lomb today. Even though it was down quite dramatically already, it missed the numbers and the stock got cremated again. So I don't see the conditions that would be suggestive of a bottom. I think we can have a short-term bounce at any time. I don't think coming on now and being negative is blazing a new ground. Now, my theme has been that we've had the most inappropriate combination of fiscal monetary policies in our history. Okay, we have pulled demand forward. Unless we're heading to a fiat currency, I think that we're going to have to deal with these problems. And interest rates are very low, too low relative to inflation, and our fiscal policy is out of control. We basically we had $20 trillion of federal debt in 2017, and 4 years later we have $30 trillion of debt. That's a growth rate in debt far in excess of the growth rate of the economy. So I would say we got to pay a price for this pulling demand forward, and I have a conservative view. I think either the Fed or oil prices will ultimately push us into a recession. I do not expect a recession this year, so therefore I don't think the market's going to get cremated from here. But I think the ultimate low is lower next year. I think if I had to call a shot, I'd say I think 4,800, the high for the year, is in. I would avoid bonds, and I would buy only selectively, and I would buy within my power space. I'm a low multiple asset value oriented investor. I do own some of the technology stocks. There's nothing expensive if interest rates remain at these levels. The point I've been making for 3 or 4 years, if interest rates belong at these rates, then basically the returns in the stock market will be very modest. You know, there's a capital market line. Your return in fixed income has bearing for your return in equities. And if your returns in fixed income are going to be as low as 3% or lower, right, then your stock market returns are going to be lower than people are used to.
If 4,800 is the high for the year, that's in, and you don't think we're at the bottom now, I mean, how much lower do you feel like we need to go before you're confident enough to say, you know, if not the bottom, I feel like we're close enough that you wouldn't be as cautious as you clearly are?
Well, I would say this, that look, stocks are heterogeneous, bonds are homogeneous. If bonds of the same quality rank move within a quarter point of each other, the stock market is heterogeneous. There are some stocks already at their bottom. There are some stocks that have a lot more downside. So I try to traffic where I think the risk-reward ratio is much more attractive. But if you want to talk aggregates, basically a bear market is about a year of declining stock prices, with a decline peak to trough average of 25 to 30%. Okay, I think if we are going into a recession, most recessions are accompanied by bear markets. I don't want to tell you I have the answer. I have people that are very smart tell me the inflation rate is going to be 2 or 3% at the end of the year. And I have others like myself think inflation will be twice what the Fed says is acceptable. One thing I know for sure, the Fed has been asleep here. I said in your program, not last month, but 6 months ago, that if Powell was right on inflation being transitory, I would tip my hat to him. You know, 64% of a typical business cost is labor. Labor is not moderating. There are a lot of things going on that trouble me. But I would say stocks versus bonds don't trouble me. I think stocks are basically cheap.
So Patrick, stocks or bonds?
I would definitely say stocks. There's no question about it.
That's what Lee Cooperman said. Okay, Patrick, when do we have a bottom per Lee Cooperman?
We have a bottom when the stocks that were following stop coming down out after good news.
Patrick, you said the opposite. What video? You're gonna have to go back and look at that video. And guys, when we do our pre-production, we're doing this live and we're reacting live. Patrick did not see that video.
I did see it, but no. What he said is that when you know, because right now stocks are going down, and
all right, Patrick, let me stop you there before you get yourself in trouble. What Lee Cooperman said, for those who may go back and watch that video, what he said was that you'll know when you have a bottom, and this is a guy who's been through like so many bear markets over his time. And again, the reason why these guys are in the market is because it comes with the territory. Bear markets, people make money and lose money. But in a bear market, you want to limit your losses and you want to have more cash. And you definitely don't want to play options unless you know what you're doing. And even
Exactly.
that is very tricky. But what Lee said, Patrick, was that you have a bottom when bad news comes out in earnings and the stock does not react negatively, or the stock goes up a little bit. So until we have a period where negative information comes out about stocks and they do not react to those, that's a bottom. That's what he said there. Okay?
Yeah.
So-
I think I said that in reverse.
Yeah, you said that in reverse. So I wanted to stop you before you put your foot further in your mouth. Okay. All right. It's all good,
Appreciate
though.
that.
And again, in our pre-production, what we do is we kind of line up what we're going to go over, but we have live reactions on camera so that you guys get an authentic experience from two investors that's in the market. So, Patrick, let's go with the 4 ways to survive a bear market, because I honestly believe we're in a bear market. And so that means hold on to your seats, hold on to your hats, and survive this. Cash up. If you're in stocks deep, hold on to solid companies. So how do you survive here, Patrick? Let's get into this.
Okay, so the 4 ways to survive and prosper in a bear market. And this is an article put out in Investopedia, and that's another really good source for investment information. And as we were saying before, bear markets are a fact of life. However, it can be hard to anticipate them, knowing how long they will last and how severely they will impact stock prices. Because bear markets are a natural part of market cycles, not only can you survive them, but you can also position yourself to benefit from them. Below are some of the techniques that you can use to either reduce your portfolio losses or even make some money off these bear markets. And the key takeaways from this article are, while investors cheer the arrival of a bear market, there are some smart strategies that an otherwise long investor can use to make most of it. Getting defensive and buying protective puts is one way to limit your downside losses. If you're well versed in derivatives and have a lot of experience, you could try that strategy. But for new investors, I would stay away from options. Also, keep an eye out for oversold values, buying shares of great companies when they are on sale at deep discounts, like I was saying about the clothing store analogy.
Okay.
And yeah, go ahead.
So what is a bear market? I think we talked about this a bit just to save some time. I want to get into some stocks. I just saw something in the chat. Alita Turner was asking about Tesla. So we're going to go through Tesla. That is a very popular stock. I want to share some fundamentals on Tesla. I'm not going to go over the technicals, but I will go through some fundamentals on it. So a bear market basically is what, Patrick?
A downturn of 20% or more in the overall stock market.
Yeah, so that's
that
what
could
it
be
is.
The Dow Jones or the S&P 500.
Yeah, and people can pause and read this if they want to read this so that we can keep the show moving.
Exactly.
And you know, and there's additional information. You can go to Investopedia and get this information. I thought this was kind of good, Patrick. This gives some historical context. So will you get this particular paragraph here?
Yeah, I could definitely blow this up. So a 10% correction is not the problem. Most investors can stomach that. It's the 78% correction that we saw with the tech bubble. That we saw with the tech bubble bursting from 2000 to 2002. I remember that. That was very, very painful.
I lost 80K in that one. And if I would have got out of the market, Patrick, I wouldn't have been able to make hundreds of thousands of dollars afterwards. This is normal cycle, guys, but go ahead. But I lost $80K on that downturn. $80K that I couldn't afford at the time. It hurt me badly, but I didn't give up. But go ahead.
Yeah, me too. I mean, I lost significant amounts of
Yeah,
money
because
too.
I sold, though. I was stupid enough to sell versus hold on, and I didn't know how to pick good companies. And that's the key. You need to know how to pick good companies so that when we ramp back up, that your companies ramp back up and you're not in, overpriced companies. But go ahead, Patrick. I'm talking too much. Go ahead.
No, it's okay. Or the 54% lost by the Dow Jones Industrial Average between 2007 and 2009. That was the financial real estate blow up.
And I won there. That's where I won. I wasn't in the market at the time. I jumped in there, and that's how I was able to pay off some real estate and all of that good jazz. I jumped in there. So because I was out in 2000, and then 2007, I jumped back in. And actually 8. So, all right, Patrick. So for those who are not in the market, this is a great long-term investing opportunity. And you can go to Investopedia, or you can just pause this if you want to read additional information here. So, Patrick, let's get into some stocks here. Okay?
Yes.
All right. So let's start out. And I want to capture the leader turners Tesla for sure. So I tell you what, I'm going to jump through my pick I had here very quickly. And then I'm going to come over to Tesla. And then we'll wrap up the show. Okay. So Patrick, here's a stock I want people to consider. We've been talking about this stock forever. It is a 5-star pick now. We were pointing it out when it was a 3-star, 4-star pick. And for those who do not understand this whole star stuff, Morningstar rate quality companies, and they give it 3-star when it's fair value price. They give it 4-star between that. And then 5-star means the stock is really oversold and very cheap. It is a good buy. So, and it's really based on valuation, how cheap the stock is. Let me show you this 5-star pick that our audience would be familiar with. And guess what it is, Mr. Durity?
It is Ford Motor Company.
The Ford Motor Company is now a 5-star rating. If you go back and look at older shows, you'll see that I've been talking about this company forever. Let's go over a few things here. Being a 5-star rating, what is fair value for Ford per Morningstar? It is
$24
and look
a
where
share.
And look where it last closed. It
Wow,
last closed.
$12.50.
Yeah, $12.50 a share. So this is a good stock for our newer, younger investors that do not have a lot of capital to buy some of the high price share companies. And so you can get shares in this company for only $12.50 per share. And it is priced very nicely right now. And on top of that, you can read all about this company from an article, May 12th, in the Morningstar Premium section. Now, how do you get Morningstar Premium? Go to www.betoutofdebt.com. You'll see all of our older episodes. I show you how to get this $30 a month premium service for how much, Patrick?
Free.
For free. I'll show you a hack how to get this $30 a month for free. Just go look at that Morningstar. And I did a short excerpt, like a 3-minute excerpt, so you don't have to watch the whole Bet Out of Debt show that we did on that. But so you can go to Morningstar, use the hack that we did in the past. You can read this article from May the 12th. They give you some convincing evidence, convincing reasons why you should consider Ford. We've been a big proponent of Ford. We've done episodes. We talked about the CEO, Jim Farley. We talked about Doug Fields that they stole from Tesla. And so we're big Ford guys here. And you can read more. Then as well as, let's look down here. let's look at some other things that you can get on Morningstar. And I'm going to go to Yahoo Finance in a minute. I'm going to skip valuation because we will do valuation on Yahoo. But you can look at the ownership, and you can look at the top 5 holders from a funds perspective, so mutual funds, an institution, and you can look at how they are buying. And let me see if I can do this, and you can see when they start to purchase. So back as early as March 31st and April 30th, the top 5 holders of Forward from a fund perspective, they've been mostly loading up. And then you can look at buying versus selling. So here is the buying. So additional amount bought here, as well as sellers. So we could click on who is selling from the fund's perspective, the top 5 sellers. So you got all of that information for your purposes. But for me, that 5-star rating is a good opportunity. Now, let me look at Yahoo Finance that I already have up here, guys. And you know, friends of the Bet Out of That show, there's 2 tabs that we look at from a technical, fundamental, I should say from a fundamental perspective. We look at statistics and then we look at analysis. Those are the 2 that give us a good indicator fundamentally on a company if it's cheap or not. Now, the forward PE for Forward is only 6 times the forward, and you can look at the past valuations. So this is how much you pay in times earnings. So back a year ago, Forward was trading at 11 times earnings, 16 times earnings, and then Forward is only trading at $6 times forward earnings. And guys, you know we want this below 20. Forward has traditionally traded cheaper, but it's even more cheap now. Now look at the PEG ratio. PEG ratio, we typically want that below 1, and Forward is trading at 0.3. So well below 1, a good PEG. And in past shows, we talked about price to sales. Look at that, 0.38 times sales Forward is trading at. So really good fundamental story there in the key metrics. But hey, Patrick, there are a few things to consider in risk, and I want to cover those risk items right now. And then I'll get to Tesla in a moment. Return on equity is high compared to return on assets. So that can tell you that we got some debt issues, and we do. So this is the thing to be concerned about with Forward, if one were to be concerned. And that is the debt. Now look at the debt, $135 billion. Look at how much cash they have, only $28 billion. And look at their return from operations, only $14.7 billion. So typically we like the return from operation, which is EBITDA, earnings before interest, taxes, depreciation, and amortization. That's a fancy word for returns from operations. We like our return from operations to be able to cover the debt. Obviously, $14 billion cannot cover $135 billion in debt. And then we look at the cash too on hand to see if we have that delta coverage, and we do not. But that's if you're concerned that the Ford Motor Company is going out of business. Patrick, I don't think
Which it is not.
The government is not going to let the Ford Motor Company go out of business. And
keep in mind, one thing I would like to add is that the car manufacturing business is a highly capital intensive business.
And that's where I was about to go. So it's just the nature of the business. All right. So let's go here, Patrick. Let's go over to analysis. And why do we go to analysis is because we want to know the growth rate of a company. So in Yahoo Finance, you can put in the ticker. I'm here on Ford. And what we pay for in stocks, we pay for growth. We pay for earnings per share growth. And earnings is just a fancy word, like I say all the time, for profits. We're looking for profits growth. Stock price is directly proportional to earnings growth. So you go to the bottom of the page here and you look at the Ford Motor Company and look, Patrick, current quarter, 238% projected growth. Current year, 21% growth in an inflationary environment. And then over the next 5 years, 74% growth. So a highly growth company trading very cheaply. That's why I like the Ford Motor Company. Now,
Yeah.
go ahead, Patrick.
And I was about to say the reason why it has such a high growth projection is that it's investment in the EV space.
Yes, yes. So, I'm a big fan. Now, Patrick, we do not talk about Tesla a lot on this show, but let's talk Tesla. I'm very happy. Now, I am not a stockholder of Tesla. And Patrick, can you guess why I do not own Tesla? I'm about to show you, but why do I not own Tesla?
You're probably not owning Tesla because it's an expensive stock. It's probably still have high PE multiples, high PEG ratio.
Exactly.
And the growth rate might not be as you may hope.
The growth rate is crazy, actually. But
Okay, well,
I'm not willing to carry the risk of that when I have companies that I can buy more cheaply, and cheaply means price times the forward earnings, the forward PE. So the forward PE and the PEG ratio, price to growth, those are my main two fundamental indicators to tell me if a stock is cheap or not. And let's look at Tesla and see why a lot of people are going to make a lot of money in it, but I don't have the stomach for the risk for it right now. So let's look at that. So let's look at Morningstar, Patrick. I'm going to go to Morningstar Live, and I'm going to put in TSLA. Now, I do want to own Tesla. Do not get it twisted. I'm going to own Tesla at some point, but I need the valuation to come down a bit before I can own Tesla. So let's see if we can get this to work. My computer is tripping a little bit. Let me refresh on this and see if I can get Tesla to work here. All right, so let's go TSLA. Such a popular stock. Let's click Tesla. Let's see what Morningstar rates Tesla. Patrick? See if I'm curious to see this live online. Okay. Live on air, I should say. All right. So Tesla is right at fair value at 663. It has a 3-star rating. Fair value is 750 per Morningstar. And Morningstar is super conservative, guys. So that means Morningstar rates things low so that you can get a great price. So Morningstar is saying Tesla is a good price right here. It's at fair value. Not a great price, but a good price. Look what the 5-star rating Morningstar says Tesla should be. $375 a share. I think Miss Jams I see Miss Jams in the chat. I think she just saw something there that I'm going to point out. Yeah, I'm going to point that out in a minute.
Okay.
But let me go to the bottom. I'm not going to look at the valuation here. I'll look at the valuation on Yahoo. Let's look at the major funds. You saw Ford earlier? Did you see Ford earlier?
Yes, we did.
The major holders, whether buyers or sellers, look what the major holders are doing.
Oh, it looks like they're selling.
They're selling Tesla. And I'll tell you why they're selling Tesla in a moment. And then you can break this down, guys. Just go look at the past episode. You can look at who's buying. There's some guys buying. These are top 5 guys that are buying. And then these are the guys that are selling. And then you can go here and do the majors, who's buying and selling. And then you can even go to the institution here, guys. So you got people loading up on Tesla too. So it's a fair value. You have to do your assessment. Let's go to analysis and let's show why Mr. Troy, bet out of debt himself, is not in Tesla right now. Because Tesla is a little rich for my blood in an inflationary environment. So for tech companies, and we always go to statistics, guys. For tech companies, we want the PE ratio, the forward PE, to be below 30s. Some would say even below 20. So we do not want to pay more than 20 times earnings in this environment. It used to be 30, Patrick. Now it's crazy. Look what Tesla is trading for times forward earnings.
It is trading at 55, almost 656 PE.
Almost 56 times what it's going to earn in the future. That is extremely expensive in this environment. So you know what that means? They better be growing a heck of a lot to justify that premium in price. Now, the S&P 500, Patrick, the S&P 500 is trading at what, about 18 times the earnings?
Something like that.
18, 19 times. So that's
18 to 20.
Yeah, that's the benchmark. It's not trading at 20. So the benchmark is you don't want to buy companies more than what the general top 500 companies are trading at per earnings. So right now the S&P is trading at, I'm going to say 18. It could be 19 times the forward. These guys times, and let's not look at the trailing. These guys are trading 55 times. Look in the past, Patrick. This is why I do not own Tesla. They were trading at 107 times forward. 121 times, 104. So for those who own Tesla, there's risk for Tesla to come down to 30. So that would be a significant haircut, meaning the price would come down even more. Now look at what you're paying, times growth. This is, you want this to be 1 or less or near 1. So you're still paying 1.5 times growth. Now you can see in the past, you were paying a lot for growth, but it was a different environment, 4 times growth. So that's what the PEG ratio is, the price to growth rate. 1.5 is not bad for Tesla, as you can see. So there will be a bottom at some point. And then look at the price to sales for Tesla. We want this number to be 10 or less, and that's slightly elevated at 12. The point is I can see Tesla coming down a little more, but certainly Tesla is getting more attractive. And then let's look at Tesla's balance sheet. Tesla's balance sheet, I think, is pretty good, actually. Return on assets, we like that to be 15 or more. It's 10, 28. Okay, so let's look at the debt, and I think Tesla does a good. Oh yeah, look at the balance sheet. This is why people like Tesla, guys. Look at the total debt for Tesla, $7 billion for a car company. That is good. And look at the cash they have, $18 billion. They have enough cash to cover their debt. That's how good Elon Musk is running his company. But not on top of that, that's not enough. Look how great Elon is and why this company is such a great company. Their total debt is $7 billion. Look at what their income is from operations, from EBITDA. $12 billion. 12.7 billion. They make more than enough from operations to cover their debt of $7 billion. Pristine balance sheet. Love that. So a great solid company if you want to invest in a company like this. All right, Patrick. So we looked at the statistics. Shout out to Big Bass in the building. Let's look at analysis here. Okay. So from an analysis perspective, let's go to the bottom. And let's look at the growth rate, because to justify that kind of premium, Tesla must have a crazy growth rate. Okay, so it's 51% this quarter growth. That's crazy good growth. 69% projected next quarter for the year. 81% for the year. Wow. But then let's look over the next 5 years. 40% growth rate over the next 5 years. I'm not sure if you remember what Ford was over the next 5 years.
I think it was 70 something odd percent.
With less
So,
risk.
Ford with much less.
Only the debt. The debt is the thing. And typically we get concerned about debt when we think a company is going to go out of business. So if you don't think Ford is going to go out of business, but if you want to invest in Tesla for the long term, it's definitely a good long-term play. Just think it's a little expensive at these prices. So that's kind of what we wanted to do. We wanted to share basically that, yes, we're in a bear market. But just like in the NBA, Patrick, injuries comes with it. But you still make millions of dollars in the NBA or the NFL. Injuries comes with the game, but no one's stopping the opportunity or taking the opportunity to play professional football because of injuries, because the upside, the amount of money you make is too great. And same here. We're not getting out of the market. Long term, we're buying great quality companies like Ford, like AMD, like NVIDIA. That's still a little expensive, so I'm not buying NVIDIA right now. I'm buying AMD. You can do the same thing that we just did for AMD. And
I've been buying AMD.
Yeah.
Just
so
a little bit as it comes down.
Exactly. So yeah, man. And Lee, that was for you. Because of you, Lee, our show is what it is. So I'm going to open it up to the chat. We got the chat. We got different comments in here. We got the lead attorney in here. The lead attorney said, thank you. Said thank you. I think the lead got some value out of that. So that's cool. Any other crazy growth from Reginald? Shout out to Reginald. Lead attorney, I'm telling you, Troy, might be time for you to pick up some shares. It might be, but that 55 PE lead, I'm not feeling that 55 PE lead. I rather pick up me some Ford and just miss the Tesla upside and get me, what was Ford PE, like 3? Ford PE?
Yeah, it was
6. It was 6.
It was 6. It was 6. The PEG ratio was 0.3.
Yeah, so yeah.
However, I mean, if you have a really good long-term perspective for Tesla lead, I would definitely maybe start nibbling at it, and if it comes down some more, pick up a little bit more as it comes down.
Big Bass in the building. Big Bass just did a new intro for the show. Big Bass is the guy that does, if you know Zoom to Thailand and his platform, Big Bass is the guy that does the rapping and stuff for Zoom to Thailand. And he just did a drop for the bet out of that show that's just fire. And so I have Big Bass in the building. Hey, Bass, thank you for sharing that. Thanks for the appreciation. So we got multiple people up in here giving kudos and shouts. And
we appreciate it.
Definitely. Any more comments or questions? Anything else before we wrap up the show? We try to keep the show right at an hour. And so, didn't know Tesla was dropping off like that in comparison. Oh, yeah, Tesla's expensive, bro. You're paying a premium for Tesla in this environment. But hopefully, guys, based on what we do here, you can go out and fish for yourself and kind of evaluate if you want to take that type of risk. None of these companies are bad companies. The Fords, the Disneys, the Teslas, the NVIDIA. It's just different price points, right? You know, I was just looking at Disney based on its earnings. I got 50K up on Disney right now. But Disney's expensive right now. So I need Disney to really perform on the COVID reopening. And then Disney earnings go back up and I will recoup. But right now I'm down on Disney. So, but the kind of information we share allows you to fish for yourself. And that's what we're about here. looked like Reginald said, when will I see the Thailand stuff? Yeah, I'm going to have Richard Mack on the show in the next week or two. So yeah, we'll have Richard Mack, Zoom to Thailand, come up and speak. I'm going to have Troy White from Kenya come back and speak. I got my boy JJ, who's an established actor, John Marshall Jones, that was the star in, what was that series? He was the smart guy.
He was the smart guy,
Yeah.
where he played the father of this really intelligent kid.
Yep. So take a look at that. Oh man, the lead attorney says, can you look at PayPal? Sure. Lead, you're not the only one deep in PayPal. I got suckered into PayPal too. I got suckered into PayPal. So the option and the exercise on it. Patrick, you got a moment to do PayPal real quick because a lot of us got caught up on PayPal.
Yeah, we could do PayPal.
Let's do PayPal. Oh my goodness. PayPal is, oh my God. I think I own like $200,000 worth of PayPal, dude. I mean, I own a buttload of PayPal because
I had a little bit of it, and then I just sold it at a small loss.
all right, let's do PayPal for the lead attorney here. All right, so let's go PayPal. I'm going to go to Morningstar. I recommend you guys go learn how to get this for free. I think PayPal is PYPL. Yes, it is. And I just got to sign I think I got to sign 1,000 shares of it on Thursday of PayPal. This stock, oh my God, this stock has been a nightmare for a lot of us.
And even Jim Cramer himself says that it's been a nightmare for him.
Yeah, as PayPal pull up, and look what the lead said. Ford, man, you guys are old school. Tesla is like 4 or 5 companies, and your fundamentals are only looking at, yeah, you're right. You're right, lead. Yeah, you're right. Watch Tesla in 3. I agree. I mean, Tesla is much more than a car company. So, I mean, we are a little remiss by just saying that, Tesla has batteries and solar, and they have, the automated EVs that they're going to do, and, everything.
And SpaceX.
Yeah, SpaceX. So you're right, lead. Good. That's why we're on live YouTube, so that smart people like the lead attorney can bust us out, and we all can be friends. Now, PayPal, Patrick. Look what Morningstar's rating it. 5 stars. So let's look at fair value price, 139, and last closed at 80. Their 5-star rating is $83. And then here's the write-up of May 13th that you can listen to this analyst talk about PayPal by just going and looking at the past excerpt we did on it. So let's see what the big boys are doing down low. So from a major ownership from funds, they're mainly acquiring PayPal. So down here. And then let's look from an institutional major. And the institutional guys are selling it. So it's mixed. So the big funds, meaning mutual funds, are buying. The big guys here. And you can look at the dates. So they were selling back in December, right? And then let's look at the funds. The funds were buying, and mutual funds were buying recently. Okay? So that's some good information. Let's go and let's look at, I am on Yahoo Finance, right? Let's go look, PYPL. Let's look at, now, again, I'm not looking at the technicals. I'm just only looking at the fundamentals. So we're not looking at support and resistance. But let's take a look at this. Can I get this sucker to blow up? There we go. Let's blow this sucker up. Okay, so let's go to statistics and we do analysis, right? So let's go look at the statistics. Forward PE. So we kind of not use that. We use this. Forward PE, 21 times forward.
So that's attractive for a tech stock.
attractive for a tech stock. That's why I think Tesla may come down quite a bit, but still above the market 18 times, right?
Yes,
Yahoo is
yes.
below. Yahoo, for instance, is below the S&P. So Yahoo would be different, and you could do the same thing for Yahoo, right? But so yeah, right here, current price, and then you can look at the past. What PayPal went for. PayPal went for as much as 63 times forward earnings. Let's look at the PEG ratio, the price you paying to growth.
So it's about 1.
It's about 1. So you're paying fair value. That's good. Price to growth 1. That's good.
That's very good. That's very good.
Good for the amount of money I have PayPal. I'm feeling a little better about my PayPal. Price to sales, you're only paying 3 times the sales. So 3 times the revenue the company earns, that's not bad. You know, it used to be 15 times sales. So as the company continue to grow and execute, we should see these numbers go up, and people are going to be willing to pay more of a forward. And as people are willing to pay more of a forward, we'll see our PayPal stock price go up. Now let's look at the balance sheet. And this is our quick and dirty. Management effectiveness, return on assets is not good. Return on equity. So there must be some debt here, I suspect. So let's look at, there we go.
Yeah.
Here we go. Total debt. Oh, it's not bad.
But it's compared to the total cash.
Yeah, 10 billion. It's not that bad. Cash,
And
7 billion.
And Miss Jones pointed that out.
And then look at the return for operation, income for operation, the income for EBITDA. So it's almost 5 billion. 5 and 7. You got 10. It's not bad. It's okay. Let's go look at
for a tech stock. We could do better than that.
For a tech stock, we could do much better than that. You should see AMD if you want to see what a good one looks like. But for the sake of time, I'll just do this one, and then others can do that. Let's go look at the future growth rate. So we're going analysis on Yahoo. And hopefully this sucker will load up. Let's kind of load it up here. And there we go.
Yeah,
so,
no, we're good.
We're on the analysis page here and on Yahoo Finance. And we go to the very bottom to just look at the growth rate, guys. And next 5 years, 15% projected. That's not good for us. That's not good for us. That's why it's priced so cheaply. Next year, 24%. And look at the projected, the current year, 15%. We're in an inflationary market. So we got mixed reviews here. You be the judge. Patrick. I don't know.
I don't know either.
Might be in trouble.
I'm not sure how much trouble you'll be in, but it'll take a while for that stock to really appreciate, or put it this way, things would have to be so perfect, like this inflationary environment would have to dissipate significantly.
Yeah,
but it will still be around. I mean, I got faith in PayPal.
Yeah. Gotcha. Okay. Well, guys, I mean, that's kind of it. Yeah. Hey, Lee, it's my pleasure, the lead attorney.
Yeah, mine too. Good shout out.
Yeah, the lead attorney is everything to us at the Bet Out of Debt show. So, hey, guys, I hope you enjoyed that. I hope you enjoyed and learned something today, and I appreciate all of the likes and the sharing. So, and also leave us a comment if you have additional comments. We check those on the regular. This has been the Bet Out of Debt show. We call this show the Bet Out of Debt show because when you place a trade, it's called placing a bet, which is a metaphor for just investing. I don't know why they call placing a bet. Investing, placing a bet. But hopefully it's a winning one to keep you out of debt. And as always, keep investing, and we will see you next time. Same channel, same day, same time. Take care, and goodbye.